So today I'm recording this session, and before we go to the contents, actually the contents, I want to revise the content that we did last week, economic value added, because I got some messages from the students that they want a little bit more discussion about the phenomenon of economic value added. And I must confess that the spreadsheet which I shared with you last week, it was not complete. So I later on I realized that there are certain bits of information I should add more to clarify this whole concept. Okay, so we shall be doing economic value added EVA once again today. So yeah, that's my plan is. But before that, there were some minor issues which I realized in Moodle, and now I'm clarifying it. So basically, there was one little discrepancy. It was the dates were swapped. Your assignment submission last date is 17th of December, right? 9 o'clock. Is it 9 o'clock? I think I'll show you what exact time is. And it should be in the return box, which is here, I guess, which is here actually. Or is it here? Yeah, it should be learning outcomes workload. Yeah. So here is the return box. And you can see that the return box is called final group assignments. As a matter of fact, you can, if you're working individually, you can add in the same. It doesn't matter, yeah? Whether it's a group or individual, this is the only return box. And the deadline is 17th of December, 9 p.m. So this return box would close on 17th of December. So you better, I would say that, because if everybody is going to submit at 8:59, then maybe the system could be having some issues. So try to submit them in before the deadline is over. And the only way to submit your assignment is the return box, because it is in sync with the plagiarism check. That's why. The question is assignments. There'll be 8 group tasks, okay? And if you are working in a group, you need to do all of them. But if you choose to be the individual, then the 5 task is something you are required to do, okay? And task 1 is compulsory. So if you do the task individually, you have the right to choose any 4 tasks, but task 1 is mandatory. You can't avoid it. Any doubt about this? Any questions? So task 5 for individuals, but task 1 is compulsory for everybody. For the groups, of course, every task is required. December 17th, again, 9 p.m. Helsinki time, final group assignments. And the name of the file, when you submit, when you upload the master file, make sure that all the names of the group members are clearly written on the page 1. Even if you're doing it individually, still write the name of the person. You can do this way. Of course, you'll be uploading the master spreadsheet. For the explanations, you need some text description. For the description, you can use the Word file as an attachment where you can explain the things, or you can explain in the given task. You can even put the text in the spreadsheet itself for each task. And that I think that'll be even better, because then I don't have to consult 2 different files separately. So I can see your calculations, and at the same time I can see your explanations in the same file, basically. Any questions about this? December 17th, group 8 task, individual 5 task. Task 1 is compulsory. Settled. 90% of your credits will come from group, or individual task. Remaining will come from your, the discussion forum activities. I hope you are active there. Then your course ends on 10th. So next week will be the last lecture. But again, that will be optional. If you find that you have nothing to ask, then because I will not be teaching anything new on 10th. So it's totally optional to come or not to come. Only come, rather, if you have anything to ask me. What else I need to talk to you? From Moodle, I have removed the lecture on 17th of December because there's no lecture on 17th. So as you can see, the last one is on 10th of December. And that too is optional. Okay. Anything else to say? There is no exam. As you can see, your tasks are the only thing you have to do. So there is no exam. There's no in-classroom exam. There is no online exam. Task includes everything, basically. So whether if because we have many exchange students here, so if you leave early, if you're in Finland or in Germany or in Austria or in France, it doesn't matter. It doesn't matter. But that is because you might be in different time zones. So that's why I have to write 9 p.m. Finland time. Because when it's 9 p.m. here, it will be 8 in the Eastern European time. Is it ET? Whatever, So there'll be in major countries in France, in Germany, it'll be 8 p.m. I guess. So the only problem is that if you come more from East, let's say if there's some Russian students, then it could be a confusion, but otherwise it doesn't matter. Okay, any question about the technicalities about Moodle and all that stuff? And once again, if you haven't got a chance to access properly, your study material is very comprehensive. You have the lecture slides. We have done majorly all the tasks from 1 to 6 are in topic 1 to 3. But tasks 7 and 8 were exception. I didn't discuss much of theory. I did actually, but more like a discussion, the classroom thing. But I didn't give you slides, and I don't think there is a need to give you slides either, because as long as you understand the idea, it's okay. Task 7 and 8 I have created now, and they're based on the task 7 is Monte Carlo model, and the recording of Monte Carlo model is available here. Some recordings are pre-recorded, but I also recorded some sessions live here. Spreadsheets. For each task, there is a sample spreadsheet, okay? Monte Carlo spreadsheet is here in the context of Tokmanni, a Finnish company. The EVA, economic value added, is in the context of British Petroleum, which we shall discuss today. And for EVA and Monte Carlo, I did a recording. I would say that this recording, which you see here, is more relevant for Monte Carlo, but because for EVA, I would be recording once again today, right? There were some issues which I unfortunately, I didn't address about EVA last week, but it's a understanding between us that if you want to watch EVA recording, don't watch here. Watch the one I record now. But for Monte Carlo model, this is fine. So coming back to the main point, task 7 and 8, they're here. Yeah. So task 7 is based on the current stock price of a chosen firm. So you have to pick one firm which you might have chosen in the previous tasks. no problem. Task 2, whatever, 1, whatever. See the current stock price, and you are required to forecast the price value by applying the Monte Carlo model of forecasting with 1,000 iterations. You remember we had 1,000 different prices which we could forecast. You'll do the same way. You can have the current values of revenue growth. You can see from the company's website how much their revenue is growing, how much is their operating profit growing, and how much is their cost of equity by using the CAPM model if you want, that you can use. Or even you can assume, no problem, I will not care much, but I will care more about how you are treating those values into the normal distribution, inverse normal distribution, and how you, yes?
Question. So like based on the current stock price, that means that we also need the equity value for this.
You need the current stock price.
Yes, yeah. But like to calculate the equity value, are we supposed to use like market cap, so enterprise value?
No. You can calculate the current stock price.
Yeah, but like we need equity value for the Monte Carlo simulation.
Yeah.
Yeah. Are we based to calculate that ourselves?
The equity value?
Yes.
No, see in the web page.
Okay.
That should be the starting point. The equity value, which I also did, that was the price of stock money on that day when I did this calculation. Yeah. So start with the current price. We can make it more complex if you want.
I'm just confused because like equity value is something different than enterprise value.
No, we're not using enterprise value.
But like the value of the market cap is enterprise value, not equity value.
Sorry?
The market cap is enterprise value, not equity value.
The market cap is calculated by the current stock price multiplied by the number of outstanding shares. Okay. So is it enterprise value or the market value of the equity?
It's enterprise value.
How do you calculate market cap?
Right. It's just that.
Yeah. So the price of equity.
But that's something different. If you use equity value, that's for example, if you like build a dividend discount model, for example, then you value a company based on the dividends, or you can also do the ECF, or like capital, and then you use the enterprise value, which is based on the market cap, and then you subtract net that and get like equity value. That's why I'm confused using equity value here. No,
we use the equity value because we are using a different model of, and first of all, we're not valuating.
Yeah, for sure, but like that.
It's a forecasting.
Yeah, I'm just confused by the names, like the difference between equity and enterprise value.
No. It's an equity value, and based on the existing equity value, we are just forecasting that if there are given risk, and if there are given, if we plot a normal distribution, what could be the 1,000 different values around the mean? And more you are diverting away from the central value of the normal distribution, more is the riskiness. So we want to see that are they the values more condensed? So basically, we are dealing with a statistical concept of skewness and kurtosis, technically, which I didn't teach because it's more statistical. So we are seeing basically spread. So is that so that after forecasting and you plot them, does it look like a normal distribution curve? Or is it like a right-tailed or left-tailed? Or is it like a very soft, normal distribution, bell shape? Or is the top is too broad or too narrow? So that kind of things we are observing in it. So we're not doing any evaluation with this. It's just a forecasting that what could be potentially different values moving around the mean value of the current equity value. Because debt is usually not tradable. That's why we are not adding to it. Yeah? Yeah. Any more questions? Any more comments about it? So you can either calculate the revenue growth rate, operating profit growth rate, or cost of equity. As a matter of fact, you have measured the cost of equity already when you used CAPM in task 2. So either you can take those values or you can make some assumptions, no problem. And also you have to make assumptions about the mean and the standard deviation values, because I don't expect you to make the calculations. Okay, so here you can make some assumptions, reasonable assumptions, not the fluke, but some good, justifiable assumptions. That's task one. Task 8 is about economic value added. You need to pick up one firm once again. It could be the firm which you have treated already in any of your previous tasks. And then you need to calculate based on year 23 and year 24, and see that how the economic value is created by the company. Okay, but don't worry, task 8, I'm going to do once again today in front of you. Yeah, make sense? Any questions, any comments? Okay, all right. Then you need to look at, this is British Petroleum. And the reason I'm doing this task once again, because one dimension of this EVA was missing, and that was that the starting point of EVA should come from some basic stock market calculations. Okay, so I took this data from investing.com. As you can see, the link is given here. And I found the year the ending on 31st of December 24, and starting on the January 1, the 3rd of January, because maybe the 1st, 2nd January, the stock. So I took 2 years data. Technically, the starting date is January 1, 23, and the end date is 31st of December 24. And these are the stock prices of British Petroleum. And the index has been taken. And like we do very often, I have calculated the stock return of the company as well as the index, which is FTSE 100 return, the top 100 companies listed in London Stock Exchange. And then we are calculating the average daily return of the firm for the year 24. And here you can see that I have only taken the year 24. Look at the column D. Column D, you can see that I only took the values of the year 24. I didn't include 23 in it. So I took, and similarly, for the year 23, I started from the cell D20256. So I separated the daily return year-wise. So as you can see that in both years, the return has been negative. And then the usual annualization process. Okay. And then the same way, the index, which is for 24. So I took the first 255 values, the year 24. The same way from 256 for the 23. And then we are annualizing the values. So we have done the index return and the company return separately for the year 2024 and 23. And then the 10-year bond rate, the data has been taken once again from investing.com. These has been 3.84%, the risk-free rate, as we say it, for 24, and for 23, 3.44. All right. And then the beta has been calculated separately for each year for 24, for 23. The company has less risk in 24 than in 23, even though still it's higher than 1, which means this is more for the risk lover investors. But the love for risk has declined over a year, or 1 year. And based on that, we are able to calculate the minimum expected return as we model it by CAPM, the capital asset pricing model. So these are the values which can be very useful if you want to calculate EVA as a starting point. All right. So nothing new. This we have done several times before. And then we go to the EVA calculation. And I took this accounting values from BP's annual report 24, because when you see 24 report, you can also find the data of 23. So I refer to only 1 year's annual report. And here the values, unless stated, are in $1 million. So the first thing I had was the two columns, 24 and 23. Starting point is the revenue, right? And then the cost of goods sold. And after we have the cost of goods sold, we are able to obtain the net operating profit. And then we have the finance cost and the finance income, then the net finance cost. As you can see, the finance cost is a cost, so cash outflow. The finance income is a cash coming in. So we want to find the net finance cost, which is finance cost minus finance income. So the net interest payment are 4,515. And then we have the profit before profit and earnings before tax, which is obtained, as usual, from the net operating profit minus the finance cost. We have the corporate tax, and then after we take away the corporate tax rate from the earnings before tax, we are able to find the PAT or EAT, profit after tax, or the earnings after tax. That's the starting point. Now, the first milestone, if you want to calculate the economic value added, is that despite we have net operating profit, we need to calculate net operating profit after tax. Net operating profit after tax. No PAT. No PAT is the starting point of the calculation of EVA. Okay. How do we do it? There are two ways to do, I guess. Did I see method one, method two? Yeah. So the method one is that net operating profit after tax. So you have NOP, net operating profit, already calculated. You can subtract tax from it. So you have so in between all the finance cost, don't worry about that. See the operating profit, net operating profit, and straight away subtract the tax from it. That is called net operating profit after tax. The reason we are calculating net operating profit after tax is that we want to distinguish the financing coming from debt and equity, because the problem with the usual accounting system is that it considers equity as a free equity, not as an expense. So to make the equity as an expense, we calculate no PAT first, net operating profit after tax. One way is that you do this way. The other way is that the method two, you can see that I have the net finance cost, I have the corporate tax, I have the profit after tax, and once again, I minus the tax, and that can give me no PAT. So there are two ways to do. Either if you want to start from top to the bottom, then I think method one is good. But if you want to have a bottom-up approach, then method two can be used. Either way, the values will remain same. So it doesn't matter whichever way you do. So after we reach this stage, we can find that the total equity value is this. And then we have two categories of liabilities. One are the financial liabilities. Okay. Financial liabilities, as you can see, there are four values here. Okay. And these are the four values which are, any idea where these four values, to which items it belong to? In the BP's annual report, I saw the current and non-current liabilities. In the current liabilities, there is finance debt plus finance or leasing liabilities. So leasing liabilities are also your finance liabilities. There are two and plus two, four items, because two belong to the current liabilities and the other two belong to non-current liabilities. But one of them is the finance debt. The second one is the leasing liabilities. For the current liabilities heading, and then the non-current liabilities. So two from current, two from non-current, that makes four different items. And these are the items, the non-finance liabilities are the ones which have no interest payment. I hope you understand that not every liability is a debt, but debt is a liability. Okay? Not everything you owe carries interest payment. So therefore, I split the total financing of the company into equity and the total liabilities, which includes the financial liabilities and the non-financial liability. So the total resources which are at the disposal of the British Petroleum in 24 are, oh my gosh, you can see how many billions it make, because the data is in millions. So if I take 1, 2, 3, 4, that is $282 billion altogether, resources available. And then we calculate, and here you can see the percentage of debt and equity. The cost of debt has been 6.3105, and the cost of equity, which you can see I took from the CAPM. So you can see that 6.352 is calculated by the CAPM model here. So I took this value. So now I know the cost of debt and the cost of equity. And shockingly, in the year 24, the corporate tax rate, the effective corporate tax rate, which British Petroleum has been paying to the tax authorities, has been 82%. Massive tax. So it means that the company has not been paying tax in the past. So maybe that's like a tax outstanding. Because you can deal with the tax man that can I choose not to pay this year, but in the future. So maybe they have accumulated tax liabilities, and because it's a good year, they earn good profits, so they choose to get rid of a big chunk of liabilities. So 82% is the effective tax rate, which you can see has been paid. So the profit before tax was 6,782, and the company chooses to pay 5,553. So big liabilities discharged. So that makes it 82%. And once we have this, we can use the VAC. As you can see that the equity is constituting 28% of the total financing. Financial liabilities are constituting 25% of the total liabilities, and the non-financial liabilities are making 47% of the total capital. And that can give us a chance to calculate WACC, which is weighted average cost of capital. And that's a simple formula. In the WACC calculation, we do not include non-financial liabilities because you don't pay any interest on it. You don't pay any interest on it. So therefore, the non-financial liabilities are excluded. So the WACC is 2.04%. Okay. So it means that the altogether, by adding debt cost and equity cost, the company on an average is paying 2.045% a year. All right. Now, this is the cost. It's a magic number because it's not just traditional accountants. They don't calculate WACC. They calculate only cost of debt. And that cost of debt, they minus, and then they are calculating the profit before tax. But here, what we have done in the WACC, we have also included the cost of equity. In other words, when you calculate the WACC, you are giving a statement that I am not considering equity as a free gift of nature. I'm also adding the cost of equity. Okay. So instead of the traditional accountants, they would use this figure 6.3105 multiplied by total debt, and that will give you the profit before tax. But here we are not using 6.3105 alone. We are taking the weighted average of this. And then finally, we are able to calculate. We have NOPAT. From the NOPAT, we are subtracting the total capital multiplied by the WACC. So that would give you the total cost of capital. It is subtracted, and that gives us EVA, which is 4296. So if you look at the profit after tax, the PAT, that is this after tax. But if you look at the EVA, this is a EVA, the economic value added, is the final value addition of the company by incorporating the debt and equity both. And this is how the value addition is calculated by the economist when they are measuring the gross domestic product of the country. Okay, so this is EVA, economic value added, the additional value added. And you can see that, and then you can see simultaneously for the previous year as well. And I calculated the proportion of equity, financial liabilities, non-financial liabilities for the year 23 as well. So these are the different proportion. Okay. So 3 steps involved. First, you need the basic accounting data, which you can easily get from the income statement. There's hardly anything which you don't know about it. And then your first milestone is to find the NOPAT. We want to find the operating profit after tax. So because the operating profit, why operating profit? Because operating profit does not minus the cost of financing. And cost of financing, traditional accountant consider only the debt, but we are considering debt and equity both. That's why we start from the operating profit, but after tax. And you can find it by 2 methods. And then you need some additional information about financing and the cost of debt, cost of equity. That's why I added a supplementary spreadsheet using CAPM. Okay, so please go through this spreadsheet and let me know if you have any queries. So remember, this is economic value added, not the enterprise value. So this is the economic value added.